Hello, everybody. Thanks for joining me again in this Monday weekly call that we do together. And I hope you've had a good week. Market continues to perform remarkably well. Maybe it's time for a little bit of rotation in the market. I'm seeing some action as people are getting more comfortable with the idea that we're not going to have a recession anytime soon. As a result of that, they're becoming more bullish. But on the other hand, many of them might have concluded that it's a little too late to jump into the mega cap 8. So they're looking for value elsewhere. And I think they should be able to find it in financials, industrials, even materials and energy. The global economy is pretty weak right now. But I think those areas of the market are probably the laggards that should do some catching up. In addition, I've been very frustrated, as I'm sure some of you have been, by the performance of the mid caps, small caps, and mid caps. And I guess in my situation, it's because I didn't really think we were falling into a recession. I thought it was a rolling recession, and mid caps usually don't do well in recessions. So I've been inclined to think that they're pretty cheap, and they've remained cheap for quite some time, as you know, but not to the extent that perhaps we're seeing some dissipation in the recession scares. Perhaps we'll see those stocks doing better because they certainly are a lot cheaper than the S&P 500. The S&P 500 is currently sporting a forward PE of 19.5. And now, of course, a good part of that high level is due to the fact that the mega cap 8 have a forward PE of slightly over 30. And when you take the mega cap 8 out of the S&P 500, so in other words, basically the S&P 492, we're looking at a multiple for that composite of 16.5, which is above the so-called fair value that historically has been around 15, but 15 may not be relevant if, in fact, we're going to continue to see that these 8 stocks dominate the market cap of the S&P 500. They're 27% of the market cap of the S&P 500. There's no particular reason to expect that they're suddenly going to implode. I mean, these are not dot-coms. This is not the tech wreck of 2000. These companies are generating lots of cash, lots of profits. They obviously got hit last year with the rise in interest rates. And as those stocks got whacked, their managers and owners decided that they didn't like to see their personal wealth take a dive, like people like Mark Zuckerberg, for example, and the folks who run Netflix. So what they did is they said, all right, if that's the way you investors feel about our stocks, we're going to show you how much money we can earn simply by cutting our costs. A lot of these mega cap 8 spend a fortune on R&D, trying to figure out what the next new thing might be. They spend a fortune on M&A activity. All they have to do is cut that out for a little while, and for a quarter or two, they can show just what their earnings power is when they're not just willy-nilly spending money on the future, and still make money on their state-of-the-art technologies that they have today. So I think that's kind of what happened over the past few months with the mega cap 8. And then, of course, the artificial intelligence excitement, hype, whatever you want to call it, took those stocks right back up, and they've done extremely well. But they've left some laggards behind, and to the extent that the market concludes that the economy is going to do better up ahead rather than worse, and that inflation is moderating, and that the Fed is approaching its terminal rate, let's call it 5.25%, 5.5%. One more rate hike on Wednesday, and that'll be it for rate hiking. It doesn't mean the rates are coming down. It just means they're going to stay up at these levels. But the economy has demonstrated its amazing resilience in being able to withstand a 500 basis points, 525 basis point increase in the short-term interest rates, with long-term rates going up, with the mortgage rate going from 3% to over 7%. And yet, despite all that, we've had a rolling recession that now seems to be evolving into a rolling recovery. I don't want to go too far ahead with that idea, because one sector that clearly is getting rolled over by a recession right now is commercial real estate. And that is one of the concerns that I hear from accounts on a regular basis. And I've been asked to address it more fully in our analysis. So we did a morning briefing on commercial real estate today, and I hope you had a chance to look at it. If not, let's review some of the points that we're making in that piece. So let's go to here. I've opened this up. This is the morning briefing. Rolling recession, rolling over commercial real estate, and there's a table in there from an organization called TREP. CMBS Research is the name of the report. And this shows that as of June, the delinquency rates by type of property for commercial real estate. And it's important to recognize, as I'm sure you do, that commercial real estate isn't just downtown office buildings. It's industrial, which has a very low delinquency rate. It's lodging, which I think historically has had a relatively high one. So 5.35% isn't necessarily something that's off the charts. Multifamily is very low. That makes sense since it's pretty easy to rent apartments these days, even if rent inflation has come down. Rent is still up from where it was a couple of years ago. And so landlords are still doing just fine. Offices is 4.5. It's up from 4.02. Now, keep in mind, offices isn't just urban buildings that have been vacant because everybody's working from home. There's also a lot of suburban office buildings, and it's not clear that suburban office buildings are suffering the same vacancy problems as the downtown. I think part of the problem with downtown offices or midtown offices in places like Manhattan and other places is that a lot of people live in the suburbs, and they realized with the pandemic just how much of their lives they're consuming with commuting to their jobs. And so they really have resisted going back to the office. And some of their employers have sympathized with that and said, okay, let's compromise. Let's have a hybrid situation where you come in, Tuesday, Wednesday, Thursday, and you can work from home on Monday and Friday. And if you want to take a long weekend someplace, as long as you take your laptop and do work during your working long weekend, that's fine. So there's been a lot of that going on. And so I don't think that the office sector in general is as widely exposed as widely feared, because I think a good chunk of office buildings are in the burbs, and I think people don't really have as much resistance to coming to work in a suburban office as they do in an urban when there's a commute. Retail has traditionally been also an area where the delinquency rate has been relatively high. Stores come and go, and you can see that it's at 646. It was at 669 a year ago. So that's some perspective on the overall commercial real estate market. It's not just all office buildings that are a long commute away for workers. When we look at the exposure of the various lenders to commercial real estate, this is in trillions of dollars. This comes from the Fed's, here it is, the Fed's May 2023 Financial Stability Report. I think the Fed's been doing these since 2018. So they do it twice a year. And so here they're addressing the issue of the commercial real estate market. They really didn't come to a conclusion in their report. So I had to come to their conclusion. And I think their conclusion is that things are bad, but not to the extent that they're going to cause an economy-wide credit crunch and trouble. That's my interpretation of the data there. But Fed Chair Jerome Powell also had an interpretation on June 14th in his press conference. Powell said that the Fed is closely monitoring the CRE sector. He observed, here, let me quote this, there's a substantial amount of commercial real estate in the banking system. A large part of it is in the smaller banks. Then he said he expects that there will be losses, and he expects that the problem, quote, will be around for some time, unquote. He doesn't expect that it, quote, will suddenly hit, unquote, in a way that causes, quote, systematic risk, unquote. And we concluded we agree with him. So it's not a trivial problem. It's not irrelevant. It's very relevant. And there are certainly companies that are exposed to losses in this area. A lot of those losses probably are going to be losses in portfolios rather than a situation where the whole thing goes to zero and it creates some sort of calamitous financial crisis. But in terms of dollars, it's significant. Banks have $2.17 trillion in CRE holdings. And again, it's not just office buildings. It's a whole mix of stuff. So it's a lot, but it's not all office buildings. The other banks would be the smaller banks. They have the bulk of it at $1.56 trillion. So they are definitely exposed, but I don't know this for sure, but I suspect that the smaller banks are exposed more to suburban commercial real estate and office buildings rather than urban ones. And I don't think the suburban are as vulnerable to having problems as are the urban, as I mentioned. Life insurers have a portfolio of $470 billion in these kind of loans. And here's the rest of them. So altogether, there's an exposure of $3.57 trillion to commercial real estate. There was a column, there's a column in the table that was provided by the Fed that shows in trillions of dollars office and downtown retail commercial real estate. It's a little, I would have liked to see downtown office and downtown retail. This looks like it's all offices and downtown retail, because again, I think the vulnerability is in urban office, not suburban. But at any rate, the banks have something like $720 billion in that kind of presumably vulnerable CRE. The smaller banks, as you can see, are also vulnerable at $510 billion. So that's not a trivial amount. And then you can look at the rest in this table. Let's jump over here. Well, let's just take a break here from the CRE issue and look at the market. I just found it interesting. I wrote a quick takes on it, and I appreciate the feedback I've gotten on it. Apparently, a lot of you like that quick takes. It's quick, and it tends to be fairly responsive to developments in the markets that might be actionable. But in the quick takes I wrote yesterday, you can see that the S&P 500 has had a nice kind of symmetrical U-shaped formation here. And we're only about 5-6% away from the record high. And it's interesting that the bear market took 25.4% out of the S&P 500 over 202 days. If you take 202 days from this low of October 12th, you get to Friday. So, 202 days down, 202 days up, and we're almost back to where we were. And when you look at the sectors, technology is actually above where it was here. I think industrials are above that point as well. So some of the sectors that were most bearish have gotten everything back. And I'm talking about, of course, the IT and the industrial sector. Let's go back to the morning briefing and just a real quick run through here, looking at the loan portfolios of the commercial banks. I think it's important to do so because now that everybody's kind of relaxing about a recession, guess what we're doing? We're just being more vigilant, looking at what could go wrong. Our bias is to be optimistic, but our job is to try to get it right rather than to provide an optimistic bias. Though I guess you know where to come for that kind of view usually. But we try to present a balanced view, and in that attempt, we do watch the weekly bank data very carefully because there is a lagged effect between tight monetary policy and the economy. And the yield curve typically anticipates that ahead of time. It inverts when bond investors conclude that if the Fed keeps raising interest rates, something will break. And if something breaks in the financial system, it could become an economy-wide credit crunch, which then could become an economy-wide recession. In other words, an inverted yield curve forecasts a process: financial crisis, credit crunch, recession. Well, it did a pretty good job. We did have a banking crisis, but the Fed came in real quick and stabilized the situation. So the yield curve's right. We had a financial crisis, but so far, we haven't had a credit crunch. We haven't had a recession. So we do want to monitor the extent to which the tightening of monetary policy since early last year, even if they stop raising interest rates at the meeting on Wednesday and make that announcement, they're still going to be doing quantitative tightening, and they still have locked in some tightening of lending standards at the banks. So we want to watch the loan data. Well, the total loans, as you can see, have stopped going up. They're kind of flattening out at a record high. So that's not exactly a credit crunch, though I guess if they're not growing, question is why? Is it the banks aren't lending, or is it the demand is slowed? And how does that balance reflect on a possible underlying recession? Well, let's look a little bit more closely at the various loans. This is commercial and industrial loans, and you can see they definitely look toppy here. Forget this. This is where we had the pandemic, and everybody ran to the corporations ran to take out their lines of credit, fearing the worst. And the Fed came in very quickly, stabilized the situation, and they paid back their lines of credit. And they did that by borrowing in the bond market at record low interest rates. So this worked out just fine. If you forget all that and argue that excluding this experience, we've seen C&I loans going to a record high, but now looking like they're rolling over. Well, why are they rolling over? It could very well be that it just reflects the inventory cycle, that merchandise, goods, inventories really piled up there in 2021, 2022 as consumers pivoted towards services. And so they needed those C&I loans for working capital. And then as these inventories have been worked down, as suggested by the loan numbers, that's really what's going on here. So it's just really part of the inventory cycle process, and not necessarily a sign that of credit tightening causing a recession. How about commercial real estate? Well, that kind of looks flattish. We've got the small banks here. They have a majority. They got $1.9 trillion of these loans, and the large banks have $0.9 trillion. And again, keep in mind, it's commercial real estate. That includes a lot of different parts of the puzzle. But it looks like things are starting to flatten out here, and that may be tightening of credit standards. It might be simply that interest rates have gone up a lot, and some of these commercial real estate projects that were on the drawing board just no longer look economically viable. So that's where we could have this rolling recession rolling to next into the commercial real estate. I think it's pretty well accepted that's where we're going. Can't say much about residential real estate loans at the banks. They do look like they're kind of turning down at the large banks. I'm surprised that they hold so much in residential real estate, but maybe they keep the good loans with a relatively high credit worthiness. But the smaller banks still at a record high. So But then again, we know residential's been in a recession. That's not news. What would be news is if, in fact, it's bottoming out, and there's mounting evidence that that's the case. Not necessarily going straight up, but certainly bottoming out. Multifamily, that doesn't look troublesome. I think there's some issues every now and then with the sample that they're using, which might explain why this is going on. But ignoring all that that occurred here, you can see that the loans for multifamily properties are still going up. Maybe here and the larger banks are starting to just be a little bit more careful about who they lend to. Consumer loans, record highs kind of across the board, though. The larger banks seem to be cutting back somewhat. Auto loans, those have been kind of coming down for a while here. And some of that is because for a while there wasn't enough supply. And now some of it is because FICO scores maybe don't allow some people to borrow money for an auto loan at these interest rate levels. Well, meanwhile, the banks are aware of the possibility of a recession and of having losses, and so they are allowing for those losses. And you can see that typically happens in a recessionary environment. If we're looking at, these are the large banks. Let's see, what are these? All commercial banks, and so they are getting ready for some losses, and that's a good thing. They're going to have the buffers. And if it turns out that the losses aren't as much as feared because we don't have a recession, economy-wide recession after all, then those losses will be reversed. And as those provisions are reduced, that would be a positive for bank profits. Meanwhile, I think we are going to see a lot of M&A activity among the smaller banks. If nothing else, the higher cost of regulation, I think, is going to force more consolidation. But who knows? Maybe some big losses in commercial real estate will force some of them to be acquired as well, either voluntarily or through the government's intervention. Well, with all that, I've left more time than usual for some Q&A, and I see we got some questions here. So let's see what we can do here. Kim, you're such a metrics guru. Well, thank you. Nobody's ever called me a metrics guru. Can you take a moment to highlight, say, 2 of your favorite stock evaluation metrics beyond the standard PE or dividend yield? What should people pay attention to and why? I can't really narrow it down to 2. I certainly focus on weekly consensus earnings estimates by the analysts and sort of stare at those numbers and ask myself, Joe and I ask each other, do those numbers make sense given what Debbie, Melissa, and I are thinking about the economy and the financial system? So we do benchmark, if you will, our thinking about earnings to what the analysts are thinking, because what the analysts are thinking, we think, is what's discounted in the market. And so if we disagree or we think the analysts are too optimistic or too pessimistic, that'll help form our view on at least the earnings part of the equation. With valuation, we monitor it and we try to be flexible about it. I think we've had to be flexible about valuation. I mean, we did get down to like 15 forward PE on October 12th, and that's back down to fair value. And back then, we also noticed that sentiment was extraordinarily bearish as it was in early 2009, which didn't really make much sense to us. And meanwhile, the earnings and revenue story looked okay. And most of the problems in earnings looked like it was basically a profit margin issue. And we had some reasons to believe that that wouldn't be long lasting. And as a result, we'd start to see some bottoming in forward earnings. And that's what we started to see. That gave us more confidence that we weren't facing an economy-wide recession. So all I can tell you is read our research, because we try to cover all the bases. And I can't say that there's any two indicators. Steve, Can you speak to the refinance risk for CRE if rates stay higher for longer? If rates stay this high, will there be a rolling crisis as CRE loans come due? The answer is yes. And I think that's what Powell basically said, is that this isn't likely to be a systematic risk issue. It's likely to be sort of an ongoing problem in a particular market, namely the CRE market. And you're right. I did in my monologue here focus mostly on office buildings that are vacant as a result of work from home. But another problem is, in fact, that rates have gone up dramatically. And there will be, I think there's something like $1.2 trillion in CRE loans that will be refinanced or not over the year ahead. And so certainly there could be issues there. But we have seen retailers and landlords and others raise their prices, raise their rents. And so I think, some of these refinancings will occur without a hitch and will be tolerable. Some of these refinancings may require renegotiating the deal, and both sides may have to absorb some of the losses. The landlords certainly don't want to see their tenants leave. On the other hand, they want their tenants to pay their rent. So there's about to be some discussions of these issues. Okay. Let me see who we got. Let me just scroll here to more questions. Why should that work? Why shouldn't it work is really there it goes. Okay. Raising rates imply a good economy, so it is not surprising that markets have worked higher. However, lower rates imply an economy that has problems, and markets tended to go down historically when rates decline. Once rates bottom, markets tend to do much better. Do you agree with this view? Yeah, I mean, look, it's rates go up when the economy is doing well and when inflation is a problem and when the Fed's trying to slow things down. And rates go down when the economy is doing poorly. So that's all true. But you got to be flexible about these views and incorporate current events. And I think in the current situation, there's still an enormous amount of liquidity. There's still a lot of people who'd like to get a better return on their portfolios. Right now, a lot of them are sitting in liquid assets. They're getting a very good return, but they realize that if inflation moderates and credit conditions continue to slowly tighten up with a lag to what the Fed has done, then the economic growth might be slow. And they might conclude that, therefore, they want to buy bonds. And, bond yields have actually been pretty well behaved here. I don't want to jinx it, but they've been very well behaved. So we'll be monitoring that situation. Sound like the Fed, right? Every time they seem to acknowledge there's this problem, there's that problem, and we're monitoring it. So that's kind of, I can't fix problems, but I can certainly monitor them. Let's see, I've got two more here, and then we'll call it a session. Dave, as a stock market investor, can you tell me what I should be looking for in commercial real estate recession? Well, we started looking at these REITs, the REITs, for the various commercial real estate components. It's kind of fascinating just to kind of let the market tell you what's going on here. Multifamily looks pretty good. Office looks pretty bad, but it looks like it actually might be bottoming. There's actually a REIT for data centers that looks pretty good. The industrials looks fine. So we'll be putting out a little we'll be posting a chart book that gets automatically updated daily on these REITs. And so you don't need me to guide you on these issues. We can together watch what the REITs are showing on a daily basis. And that's where our focus will be. Finally, William, speaking of systematic risk issues, can you add color pertaining to the parabolic increase in Fed government debt service costs? Yeah, I guess we're seeing the government's interest payments, net interest payments. Couple of years ago, they were $300 billion. Now I think we're already $600 to $700 billion when you look at the 12-month moving sum. And at the rate they're going, they'll be at $1 trillion very, very shortly within the next 6 to 12 months. I think I got that right, but that's kind of the way things are going. That adds to the deficit clearly. And that's one of the issues looking ahead here. The deficit, in my mind, is a generational issue. It's the current generation basically taking the borrowing power out of away for future generations. So we're kind of doing this to our kids, the baby boomers and the baby boomer politicians and people who run the economy have decided that to minimize the pain of all these painful things that have been happening will run a large deficit. And some of that is accumulating quickly in interest payments. And that's an issue in a generational way because we're leaving all that to the kids. On the other hand, as I pointed out recently, I don't feel that bad about it because the baby boomers have accumulated $75 trillion in net worth. Now, clearly, they're going to spend some of that. I don't think they're going to spend all of it. I think there will be a lot of money transferred to the next generation. But the bottom line is I don't think that it has an immediate market impact, which is obviously the concern I think that's behind your question. Well, I'm sure will be lots of other questions and concerns that we will have as we see how things unfold just this week alone. I hope you have a good week. It's going to be an action-packed week with the Fed, and at the end of the week, we're going to have the consumption deflator, which will be another important number. Based on what we see in the CPI, it should be a fairly moderate number. We'll see what the consumer's doing in the Friday data on personal income, whether they've continued to shift away from goods to services, which is, I think, what they're doing. But have a good week, and we'll see you next week on Monday.